Stellar XLM fans, we've got to talk. Because let's be real for a moment, this market has been through the ringer. If you've been holding through the chop, through the headlines, through the Twitter doom-scrolling nights where every candle looks like it's trying to eat your portfolio alive, you're not alone. But something interesting is happening, and it's worth zooming in on. Look around. The charts aren't bleeding red anymore. We've finally started to see green patches light up across the board. And not just those little fake bounces we've been trained to ignore, but deeper, more convincing stretches of green. Some alts are pulling double-digit recoveries. Bitcoin looks less like it's on life support, and Stellar, our XLM, has been inching forward with a quiet resilience that deserves attention. Now, I want to set the tone straight before we dig deeper. I'm not here to scream to the moon at you every 5 seconds. That's not the vibe. That's not reality. The reality is markets don't move in straight lines. They grind, they shake you out, they test your patience, and then they reward the people who stayed sharp while everyone else got distracted. And right now, as I sit here with this heat map glowing green, it feels like we're shifting away from the bottom. Why? Because markets are weirdly good at absorbing pain. Think about it. Over the last year, we've had inflation scares, SEC lawsuits, banks collapsing, tariffs being fought in appeals courts, and regulators leaving their chairs empty like it's musical chairs at a kid's birthday party. And yet, the crypto market is still here. Not only here, but recovering. That tells you something powerful. Bad news eventually gets priced in, and once it does, the only thing left is forward momentum. And that's where we are right now. Investors are finally starting to look past the doom cycle. They're beginning to whisper the one thing we all secretly hope for. Hey, maybe the worst is over. That whisper builds, it becomes confidence, and then, before you know it, it becomes money flowing back into risk assets like crypto. But let's keep it real. Green on the screen isn't the whole story. What's behind this shift? What forces are pushing Wall Street into trouble and maybe pushing some of that sidelined capital toward assets like Stellar and the broader crypto market? That's where this gets interesting. Before we break it all down, I want to give credit to the community, because this isn't just about charts or news. It's about the people in the trenches. Commenters, sharers, the ones saying, finally, someone not hyping every candle. Those voices matter. They keep us grounded. And they remind us that crypto isn't just speculation. It's a movement powered by real people who want better systems, faster rails, and fairer opportunities. So, in today's deep dive, we're going to talk about 3 major forces shaping the mood. Why Wall Street's old guard is sweating under pressure. Why investors are piling into safe havens like gold and silver, but still keeping an eye on crypto. And why upgrades like Stellar's Protocol 23, while not sexy for price action, are vital for long-term survival. And we'll stitch it all together into a big picture look at why September through November might just be the most pivotal window for XLM in years. Grab your coffee, your notebook, or whatever keeps you steady during market volatility, because we're going to unpack it all. No BS, no opium, just straight talk and strategy. Alright, let's talk about the elephant in the room, Wall Street. Because while we've been busy watching crypto charts twitch, the big dogs in traditional finance are having a very bad time. And the trigger? Tariffs. Yeah, I know, tariffs sound boring. They sound like something out of a dusty economics textbook that you only cracked open the night before an exam. But stay with me because this one's important. A federal appeals court recently ruled against Trump's tariffs, and that decision has set off a chain reaction that's rippling through the financial world. Here's why it matters. If the appeals process eventually confirms those tariffs were unconstitutional, the U.S. government might have to do something painful, not only stop collecting the money, but actually give it back. Imagine that. Billions that were collected over years suddenly being owed back to the same corporations they were taken from. That's not just a legal headache. That's a financial earthquake. Now, when that kind of uncertainty hits, markets freeze. Businesses don't know how to plan. Are they paying more for imported parts? Or are they about to get refunds? Investors don't know where to put their money. Should they hedge against inflationary pressure from higher costs? Or bet on cheaper imports if tariffs fall away? And the average consumer, people like us, are stuck in the fog wondering why the prices on shelves feel unpredictable every single week. This fog of uncertainty is toxic for Wall Street. Markets hate not knowing. And when markets hate something, they run. They run away from risk and they sprint towards safe havens. That's why you've seen record-breaking inflows into gold and silver ETFs recently. Investors don't want to play guessing games. They want stability, even if that means holding shiny rocks in vaults instead of shares in companies. But here's the plot twist. While Wall Street retreats into defensive mode, another group of investors sees opportunity. Because uncertainty in traditional finance often pushes people to look for alternatives. And in 2025, alternatives don't just mean metals or bonds, they mean crypto. Assets like Bitcoin, Ethereum, and yes, Stellar XLM start to look attractive. Not because they're safe havens in the old-school sense, but because they're outside the tangled mess of U.S. trade policy and political gridlock. Think of it like this. If you're a global investor, why would you want your portfolio chained entirely to the drama of tariffs, court rulings, and Fed delays? Diversification means finding assets that move on different rhythms. Crypto, for all its volatility, provides that rhythm. And Stellar, with its focus on cross-border payments and financial inclusion, offers something even more valuable. It's a hedge not just against Wall Street uncertainty, but against the inefficiencies of the very system creating that uncertainty. Now, don't get me wrong. I'm not saying that the moment the appeals court rules on tariffs, XLM is going to skyrocket overnight. That's not how this works. What I am saying is this. The cracks showing in traditional finance create an environment where risk capital starts looking for new homes. And every time Wall Street stumbles, crypto gets a little more attention as the place to run to when the old system feels broken. And that's the setup we're in right now. Wall Street's fumbling with tariffs, inflation, and political indecision, while crypto sits in the background, waiting for that capital rotation moment. The longer the uncertainty drags on, the more likely some of that money gets rerouted into risk assets like XLM. So when you see headlines about tariffs and think, that's not my problem, think again. Because every court ruling, every tariff decision, every policy delay, it all shapes the mood of investors. And when that mood shifts from fear to frustration, that's when crypto gets its chance to shine. Okay, so we just talked about how Wall Street is fumbling with tariffs and uncertainty. Now let's dive into what people usually do when markets get shaky. They run straight into safe havens. And the two old favorites? Gold and silver. For decades, whenever the economy looked shaky, investors piled into these metals. Why? Because gold and silver have always had this aura of stability. You can't just print more of them the way you can print more dollars, and they've been recognized as valuable for thousands of years. When everything else felt risky, stacking shiny metals was the default move. And recently, that exact playbook has been running again. ETFs tracking gold and silver have seen record inflows. Big money, smart money, institutional investors, they're scooping up these assets like they're prepping for economic winter. It's the classic. When in doubt, hold gold. But here's where things get interesting. We're not in the 1980s or even the early 2000s anymore. We're in 2025 and the financial landscape looks very different. Because while gold and silver are still strong defensive plays, there's a new kid on the block, crypto. Now, I can already hear some people rolling their eyes. Crypto isn't a safe haven. It's volatile, unpredictable, all over the place. And that's true if you're measuring safety in the old-school sense of stability. Gold and silver barely move compared to crypto. They creep. Crypto, it leaps and dives. But here's the key. Investors aren't only looking for safety. They're looking for alternatives. See, gold and silver protect wealth. They preserve value, but they don't generate opportunity. If you hold gold, you're hoping to stay safe while the storm passes. But if you hold crypto, specifically something like Stellar XLM, you're not just hedging against chaos, you're positioning yourself for growth when the old system falters. That's the distinction. Gold is a bunker. Stellar is an exit plan. And let's get practical. When tariffs, inflation, or political gridlock hit, gold might help you keep your wealth steady, but it doesn't solve the problems of transferring money across borders, remitting funds, or building inclusive financial systems. Stellar does. XLM isn't just an asset you hold, it's an infrastructure play. It's rails for moving money globally, fast and cheap, outside the drama of Wall Street and Washington. So when I look at the safe haven conversation today, it's not either or. Investors are still going to load up on metals. That's not going away. But increasingly, a slice of that defensive capital is sliding into crypto, and Stellar is perfectly positioned to catch it. Why? Because unlike pure speculation coins, Stellar has utility that resonates in times of uncertainty. It offers solutions, not just price charts. Think of it like this: if you're a portfolio manager in 2025 and you're allocating risk, do you really want 100% of your hedge in metals? Or do you want a mix, some gold, some silver, and some crypto that could multiply your returns if the financial system keeps cracking? Diversification doesn't mean putting all your eggs in one old basket. It means recognizing where the future might outperform the past. And that's why this shift matters. Every dollar that flows into gold today is just as easily a dollar that could test the waters in Stellar tomorrow. The old safe havens aren't dead, but they're being challenged by a new safe haven for a new world. So the real question isn't whether gold and silver still work. They do. The real question is, do they work better than Stellar in a world where money is going digital, borders are breaking down, and trust in traditional finance is fading? And my answer is no. They're not competitors in the same lane. Metals lock value down. Stellar sets value free. And when investors start realizing that, watch how quickly the conversation shifts. Okay, let's unpack this in plain terms. You've got two very different kinds of news happening at once, and they push markets in very different ways. On one side, you've got the big macro stuff, tariffs, court rulings, who's running the regulators, inflation prints, rate cut whispers. And on the other side, you've got ecosystem news, protocol upgrades like Stellar XLM Protocol 23. They both matter, but they move different levers. Understanding which lever is being pulled is where the edge is. First, the macro picture. The federal appeals court action around tariffs. That's not a neat one-day headline. It creates months, maybe years, of policy uncertainty. If courts say tariffs were unconstitutional or mishandled, governments could be on the hook to return money, businesses could change sourcing strategies, and corporate planning gets messy. Uncertainty like that pushes institutional players towards safety. That safety trade is already visible in the flow into gold and silver ETFs. August saw record ETF holdings. Investors are piling into precious metals because they don't like ambiguity about trade policy, interest rate direction, and regulatory backdrops. When institutional capital retreats to perceived safe havens, risk assets feel the pain. On top of that, you've got the U.S. regulatory calendar, SEC moves, the CFTC still understaffed, and Fed rate decisions. All those bodies influence whether big money can or will move into crypto via regulated channels, ETFs, custody solutions, tokenized assets, etc. There is a key point. The U.S. government moves slowly. So big catalysts often get delayed, which keeps money parked in safer places. So what's the consequence for crypto? When macro uncertainty dominates, two things happen together. Safe haven assets, gold, silver, rally. Risk assets, including altcoins and tokens, get muted, even though parts of the crypto ecosystem keep progressing technically. That brings us to the second bucket, ecosystem news, in this case Stellar XLM Protocol 23. XLM 23 goes live, 8 upgrades, all good engineering progress. That's real progress. Upgrades matter for reliability, features, and long-run adoption. But the speaker nails the point. Protocol upgrades rarely move price by themselves. They keep the project relevant and slowly build fundamentals, but the immediate price response is small compared with macro catalysts. Why? 2 reasons. Scale of money. The funds and institutions that move multi-billion flows don't react to GitHub commits or protocol minor version upgrades. They react to regulatory clarity, ETF approvals, rate cuts, and geopolitical certainty. That's the money that can really change market structure. Narrative versus utility. Upgrades are utility improvements. They improve the plumbing. Markets price narratives, liquidity, and the macro environment in the short run. Utility compounds over months and years, not minutes. Stellar posted the XLM Protocol 23 announcement on its channel, and at the time it had only 3,400 views. Meanwhile, XLM's 24-hour volume is quoted as USD 227 million and down 35%. XRP's volume is down 25%, but overall crypto market volume was up 9%. USDT and USDC volumes were down too. Translation: people were not flooding XLM with fresh speculative cash because of the protocol note, they were reacting to bigger macro flows. Look at the data: BTC volume, ETH volume, USDT/USDC volumes all shifted. These aren't XLM specific. This is cross-market liquidity reallocating. That's a textbook example of money chasing safer, or alternatively, chasing macro-driven risk on, depending on the headlines. In short, protocol upgrades equals ecosystem-level news. Tariffs/ETFs/interest rate talk equals big money news. So what does this mean for an XLM holder or someone watching Stellar? Short term. Don't expect a protocol launch press release to spark a moonshot. Price is dominated by broader market flows. If Congress, the Fed, or courts move the needle, that'll influence XLM faster than a protocol blog post. Medium/long term, upgrades matter. WISC Protocol 23's 8 improvements will make Stellar more resilient, more capable, and more attractive to partners and builders. That's the slow burn value, the reason the project can actually absorb real-world payments, stablecoin rails, and tokenized assets down the road. Tactical. Use macro calendars. Watch CPI prints, Fed statements, ETF timelines, and major court rulings. Those are the events that determine whether liquidity leans into crypto or pulls back to gold/silver. One more call out: the timing game. People want events in September. The SEC and Congress move slowly. We may be looking at October/November for larger regulatory/timing clarity. September could be rough short-term, but the market may have everything lined up by October/November for a bigger move. That kind of calendar awareness is exactly what separates noise from signal. Don't confuse an ecosystem update for a macro catalyst. If you want price action, watch regulatory moves, rate decisions, and major institutional flows. If you want durable, long-term adoption, watch upgrades like WISC 23, because the plumbing that succeeds quietly in the background is the plumbing that pays off when big money eventually shows up. There are two kinds of news in crypto. On one side, we've got ecosystem news, protocol upgrades, new DeFi launches, NFT marketplaces, partnerships, and grants. These are the lifeblood of a blockchain network. They show that builders are active, developers are shipping, and the technology is evolving. For Stellar, the WISC Protocol 23 upgrade with its 8 new features is exactly that kind of story. It's not a meme, it's not hype. It's real infrastructure being laid down. If you're a developer, validator, or power user, this is where your attention should live. On the other side, there's macro news. Federal Reserve interest rate decisions, inflation reports, trade tariffs, election shifts, leadership changes at the SEC or CFTC, and regulatory rulings. This is the stuff that dictates where billions, even trillions of dollars flow. Hedge funds don't care about NFT floor prices. Pension funds don't care if Stellar just improved fee optimization. They care about whether U.S. Treasuries are yielding 5% or 3%, whether inflation is sticky, and whether regulators will greenlight or crush certain asset classes. And here's the kicker. Macro moves markets, ecosystem news builds conviction. The reason your portfolio doesn't explode every time Stellar launches something is that the money that swings prices isn't paying attention to those updates. But that doesn't make them irrelevant. Instead, think of ecosystem news as the soil nutrients, feeding long-term growth, while macro news is the weather that determines whether crops actually sprout this season. Most retail investors mix these two up. They see an exciting protocol update and assume price should react instantly. When it doesn't, frustration sets in. Why isn't BTC pumping? Why didn't XLM break out after that announcement? The truth is, it's not that the news doesn't matter. It's that the timelines are mismatched. Builders are laying bricks for a multi-year skyscraper, while traders are staring at a 15-minute chart waiting for fireworks. This is where patience becomes your biggest edge. Historically, some of the biggest rallies in crypto came months, sometimes years, after critical ecosystem upgrades. Think about Ethereum after the merge. The price didn't explode immediately, but the foundation it set made ETH more attractive to institutions, which paid dividends later. The same could be true for Stellar, XRP, and Hedera after these recent updates. Now let's pivot to the big leagues. Why do gold and silver ETFs keep seeing record inflows? Why are funds positioning defensively even as risk assets are supposed to be in bull mode? Because macro risk is still unresolved. Inflation. Sticky inflation has the Fed cautious. Any unexpected spike can crush risk assets. Interest rates. If rates stay higher for longer, capital prefers safe yield over speculative plays. Trade and tariffs. Tensions with China and policy shifts create global uncertainty. Regulation. Stablecoin bills in states like Wyoming are huge steps, but federal clarity is still lacking. Elections. 2024 to 2025 political shifts will decide whether crypto gets regulatory sunshine or shade. Institutions move when they see clarity. Right now, they see fog. That's why capital is circling but not diving. It's also why ecosystem news feels muted. The spotlight is on Powell, Yellen, and Capitol Hill, not on your favorite protocol's GitHub repository. Let's be real. The vibe in the market this September is heavy. Even when prices flicker green, it feels like something's holding them back. That's not just your imagination. It's because September is historically a tough month for risk assets. Equities, crypto, even commodities often struggle. Couple that with policy uncertainty, leadership questions at key regulatory agencies, and sluggish liquidity, and it's no surprise people are cautious. This doesn't mean disaster. It just means we're in chop mode. Prices grinding sideways, optimism capped, fear simmering. The opportunity here is not to overtrade, not to burn out chasing noise, but to use this period to accumulate knowledge, conviction, and maybe even assets if you have the stomach for volatility. If this gave you clarity, don't just scroll past. Act on it. Stay locked in, watch the macro signals, and track the ecosystem updates that others ignore. September may feel heavy, but history shows October and November often flip the script. That's when patience pays off and capital floods back in. So position smartly, keep your conviction, and don't let short-term noise shake long-term vision. Subscribe, share this breakdown, and stay ready. Because when the fog clears, it won't be gradual. It'll be fast, it'll be loud, and only the prepared will capitalize.